Right. Good day, everyone. Uh, Morning, good afternoon, good evening, wherever you are in the world. My name is Rod. I am the community choreographer for Pollinate Impact based in Manila, Philippines. And it's great to see everyone here today. Thank you so much for joining our session on sustainable financing across the global south. We are really happy and privileged to have two awesome speakers around sustainable finance in the Indian ecosystem, and we hope to get a discussion going within our session on the experiences and challenges also coming from other regions of the global south. So as you all know, as Pollinate Impact, we always start with our check-in. So Tess, if you could kindly share our screen with our Mentimeter.
Right. But just before I do that, we could request everyone to write both their name and their organization. So you could rename yourself as your name and your organization just as I present.
Right. Thanks for reminding Tess. So as Tess mentioned, if you can write your name beside your organization, just so that we know where you are all coming. Awesome. Okay. So if you can all please join us at menti.com and use the code 68755297. Pointy and Dr. Bala, if you want to join us, you can as well on the Menti. Germany for joining us. Philippines. So we have the UK and Poland. Awesome. We have a few people joining us from Europe today. That's awesome. So it's quite early in your day, but thank you so much for joining us. Kenya is here, India as well, Indonesia. Awesome. So we have a great mix of people coming in. All right, Tess, maybe we can move to the next slide. Okay, we want to know what best describes your organization. So we see there's a lot of incubators and accelerators in the room. It's great. There are also some people who are saying hi, the chat. Nice to see you, Gregory, Andrea, Jasmine. Some. All right, so I think most of us here are who work for an ESO, an entrepreneur support organization. We have a network organization as well joining us. Great. Awesome. All right. We'll move to our next question. What insights are you hoping to gain from the session? This will help us kind of our speakers on how they can kind of present their points. So proven best practices and learnings, learning about different incubation models in the global south, sustainability model, not dependent on project-based type of work. Okay, great. All right. On a scale of 1 to 6, how financially sustainable do you feel your organization is currently? 1 being not financially sustainable, 6 being very financially sustainable. So we see that it's in 2, about 6 people answered 2. Does everybody else agree? Where are you on the scale? We have 3 as well. So somewhere in the 1 to 3 part of the scale. So I think this is our last question. What is the biggest challenge you face in achieving financial sustainability? Fundraising. Seems that 3 people agree. Fundraising is the main challenge for those wanting to achieve financial sustainability. Funder match, matching your organization to the right funder. Revenue generation. The right business model. funding that is multi-year. So not a one-year funding. Right. I think this is our last slide for the Mentimeter. Please feel free to keep answering. It's still available. But thank you so much for those who already feed in their answers. Then we'll now proceed to the main part of our session. So to give us a brief introduction of our speakers today, I will hand over the floor to Poini and Dr. Palachandran to give us a quick intro of themselves, and then we can proceed to the session. So Poini, please go ahead.
Yeah, thank you, Ruth, and good morning, good afternoon from wherever you are joining. My name is Poini Bhatt, and I've been in Indian startup ecosystem for more than 2 decades. I was managing a business incubator at IIT Bombay, which IIT Bombay, many of you may be aware, it's a leading technology institute in India. We were one of the first incubators in the country when the startup ecosystem was still emerging in India. And we had also experimented a lot with our financial and sustainability model. And I think the inspiration of today's basically presentation of highlight of the white paper came from review of many other incubators, and we realized that we have to put the knowledge together. And that's how I happen to be here. Thank you very much, Rob.
Thank you so much, Poini. I'll hand it over to Dr. Balachandran.
Yeah, thank you, Raul, and hello, everyone. This is Balachandran from Vellore Institute of Technology Business Incubator. We are a 21-year-old organization attached to a leading private university, Vellore Institute of Technology. So prior to this experience of incubation professional for the last 21 years, I've worked in the industry for about 13 years. And so in addition to the main role at Vellore Institute of Technology as a business incubation head, I also volunteer my time for our association, the Incubators Association, with about 150 members, which is known as the Indian Steps and Business Incubators Association. Poini has been one of the past governing body members, and I'm also happy to see Ashish Garde, one of our current office bearer in this call. So this has been a rewarding experience. In the past, we also had an opportunity to work with InfoDev World Bank, where we had about 7 partner countries from Southeast Asia. And subsequently, in the 2012-14 timeframe, we also partnership with UNIDO, United Nations Industrial Development Organization, where we had undertaken a capacity building program for startups and incubators from 4 West African countries, including Guinea, Cote d'Ivoire, Liberia, and Sierra Leone. So when Poini and Rob mentioned that this will also have a similar participation, I was more than happy to listen and learn from each other. So looking forward to some interesting conversations this afternoon.
Wonderful. Thank you so much. We're so happy to have you both, Poini and Dr. Bala. We are so excited to hear about your presentation and then, of course, our discussion after. So I will turn it over back to Poini to start us off with our discussion.
Poini, you may want to
You are
unmute.
on mute.
Sorry. Yeah. So just allow me to share my presentation here. Can you see the presentation?
Yes.
Okay. Yeah. So once again, it's pleasure to be here. This is the white paper that we had wrote. I'll leave the presentation with a Pollinate Network group, but for sharing. Having said that, let me also give you some objective. Why did we write this paper? One is basically we wanted to create a suggestive guide, suggesting various revenue streams which are long-term as well as short-term for financial sustainability of startup incubators. Second thing is that it also gives an indicator how how do you assess investment on startup incubator. So return on investment on startup incubator. So these were the two major objective for particular this white paper. Having said that, this has a very, very specific India context. This paper is written predominantly in context with India as an incubator group. Like, second key assumption is that in India, our government is very, very proactively supporting startups. And then there is a good amount of financial grant that is coming to the incubator as a jumpstart support that gives also cushion to us for 4 to 5 years to stabilize our operations. And third context is basically we typically now the ecosystem is quite mature. So we typically deal with startups that have potential for high growth and high revenue model. And that has reflected in some of the components for our, even sustainability model. Yeah. I'm not able to, okay, yeah. So let me, present some summary upfront, and then I will basically elaborate various aspects. So our experience has been that it takes typically 7 to 8 years to stabilize the operation of incubators. And only after that you talk about financial sustainability. So there is no shortcut. However, incubators do have to think about achieving financial sustainability from the year one. But time to achieving financial sustainability is quite long. Second thing is that revenue model for early stage incubators as well as mature incubator, they differ. So early stage incubator have a different priorities, and mature incubators basically actually reap the benefits of earlier work. So the model differ for both the different stages. Third, highlight is that typically incubators cannot sustain on a single revenue stream. They have to have multiple revenue stream and multiple client segment as a focus point. Of course, everything has to align with the startup and entrepreneurship. Otherwise, it will lose its own objective. Also, there need to be a strategic approach to create a cohort of startup that will include low gestation companies in short term, which can give quick revenue to the incubator. However, they need to really invest in long gestation company with exceptionally high returns in longer term. So there has to be a strategic approach to building a cohort that way. Next highlight is that there is a balance needed to ensure the core focus on incubating startups. So every activity, every revenue stream, every client segment that we talk about, ultimately it should add a value to the incubating startups and core objective of the entrepreneurs. And finally, incubator managers of incubators need to be having entrepreneurial mindset. So incubator themselves are typically startup, and they have risky path going forward. So their mindset also has to be entrepreneurial mindset as against the managerial mindset. Just to give you a context in startup incubators in India, India has more than 1,000 incubators since start of the centuries. And majority of the incubators in the country are in academia and R&D center, who typically focus on innovation and knowledge-based entrepreneurship. Of course, there are incubators which are basically supported by industry clusters and NGOs and foundations. There are some incubators even supported by corporate ventures, and their target cohort would be somewhat different, but most of them are also focusing on innovation and knowledge-based entrepreneurship. India also has strong mature ecosystem, so that is benefiting to incubators. So there is a strong impetus from government who give like initial grant, as I mentioned. We have very active and vibrant VC ecosystem, investor ecosystem. So access to capital for startup is easier. And third thing is that we also have many now. Most stakeholders in the country are engaging, very actively engaging with the startup ecosystem. So this is the kind of an advanced ecosystem that we operate in. Coming to the financial model, like incubators, as I mentioned, they need to have more than one client target audience as well as more than one potential revenue streams. And this is what we have been practicing for over a period of time, and we feel that mix of this, the revenue stream will be able, will enable incubators to achieve financial sustainability over a period of 7 to 8 years. Just to break it down, when for incubator startup as a client segment, they can have incubation fee, equity, revenue share, success fee. Of course, equity and revenue share are based on the premise that incubators are the first risk takers when they onboard a company, and they by reducing the cost, they actually participate in venture by taking away their cost. And the company, when the company succeeds, incubator also succeeds. So when the company fails, incubator also would lose any financial return potentially coming from equity and revenue. But of course, there would be some regular flow from incubation or success fee that would have been covered from the company. When it comes to the corporates in India are very actively engaging with startup. They have open innovation programs and so on and so forth. So incubators can engage in with a commercial model by creating some partnership program. They have corporate social responsibility fund, so that can be leveraged, and startup and corporate engagement. If there is a successful transaction, then like success in any transaction, they can charge some kind of a success fee from there. Third client segment is government and multilateral agencies who give initial or upfront cost to the incubators. They also have several entrepreneurship and startup programs and startup grants that can be leveraged to reduce certain costs, and also some program fee can be basically gained from these programs. And finally, ESOs, consulting or training or workshop or creating customized services around that. So these are the target audiences and possible stream of revenue coming from each of the client segment. I'll just go down now, like what it involves in each of this model, basically each of the component, revenue component. So incubators typically give tangible and intangible support to the startups. While tangible support like office space and laboratory facility and conference room and computing facility and internet and communication facility, all those things can be measured. Intangible support like mentoring or training, workshop, these are the things very difficult to measure the cost around. Hence, it makes sense to create a consolidated fee base for them. One can look at the cost base. So what is the actual cost from the incubator side and add little bit margin, or one can actually benchmark with market value of each of these tangible components. However, one has to take it, keep it in mind that if this is exactly going as per cost base, perhaps the cost of incubation fee will be really high, whereas startup needs a support at a significantly subsidized cost. They themselves are cashed out a starved entity. They don't have sufficient cash to pay commercial cost, and hence they come to the incubator. So that fee needs to be subsidized. Some incubators can also basically put a pay-per-use kind of, so laboratory or product development support, they can use pay-per-use kind of support. The advantage of this model is that it gives consistent cash flow to the incubator, and it's very predictable also. They know that, like, how I have this many clients, this is the cost, and this is going to be my annual revenue. The disadvantage is that it actually doesn't permit any participation in success of the company. Incubator really help them to grow, but incubator cannot take basically, share any success in the company. Startup equity, I think this is a bit very specialized instrument, typically applicable only for the high growth companies. For a small or emerging startup ecosystem where the companies are not perceived to have a high growth, this model is not really relevant or may not be suitable for them. But I'll just give you, I'm sure most of you may be aware of equity, but for those who are not exactly aware about equity aspects, and I'll share some thought, basics about the equity. So equity essentially reflects the ownership in a company. Yeah. So when a startup gives equity, the startup actually partakes with its own ownership with the third person. Yeah. For incubator, by taking the equity, is kind of a bet on the future success, because that equity has to be monetized at certain point of time, and that monetization doesn't happen so easily. Yeah. The justification for equity is that incubator provide very high quality service to the startup at a highly subsidized cost. Hence, incubator is asking for participation in equity for taking the risk at an early stage. Yeah. However, to managing this equity, it requires some kind of an investor mindset. Yeah. Some of the important aspect about equity is that as an incubator, what is the quantum that you take from a startup? If you take large quantum of equity at a very early stage from a startup, which means startup is losing significant of its ownership without any cash coming in a very early stage, and that doesn't leave much ownership for the startup to partake in future investment rounds. So hence the equity has to be very, very reasonable. It should not take away significant ownership, and it should commensurate with the value and depth of the engagement with the startup. Again, like, the monetization of equity doesn't happen so easily. It is typically linked with the next round of funding. So when startup raise a next round of funding, that's the time the previous holder of equity gets some kind of liquidity opportunity. So, and that next round of funding doesn't happen every 6 months or every year. Also, it doesn't happen in the company that doesn't have potential for the fast growth. It typically happens only with the high potential growth companies. The typical characteristic of equity model is that the exit is very long term. Also, funding events are very infrequent. But when this happens, it happens disproportionately at a higher valuation. So even exit could be really, really disproportionately high. And this model is more suitable, especially in early stage, for when it is mixed with other revenue model. Also, this model is more suitable only for the high growth company, as I mentioned. I'll give you how does it work, just to give you a sense. So typically in a startup, let us take in initial 4 to 5 years, there are four funding rounds. Yeah. An incubator holds equity of 4% in an incubator. And when startup raise fund first round, the valuation of startup is just 1 million. That so your incubator's equity, that value gets basically translated into $40,000. Assuming incubator doesn't exit or take any sell any of its equity stock, it maintains 4%. It waits for the next round of the funding that will go basically at a certain even higher valuation, say 5 million valuation. So that 4% which was there in initial 12 to 18 months, $40,000, the valuation goes up to $200,000. Yeah. And that's how basically, it goes basically exponentially higher over a period of time. Like, so if you look at the example, if the startup achieves $50 million valuation in first 4 years, suddenly the equity value that an incubator holds grows from $40,000 to $2 million. And that's a huge basically advantage for the incubator. It adds to the long-term sustainability. Plus, this kind of exit also takes away failure of many more startups out there. Yeah. So advantage of equity model is, as I said, that it's a disproportionate higher valuation, and it gives opportunity to incubator to participate in success of the company over a longer period of time. The disadvantage is that since it's an ownership, it is not easy to negotiate. There is an irregular flow of revenue, and there is a high risk of failure. I think this is another component that allows incubators to participate in success of the company, which is revenue share. And here the thing is that incubator have a negotiation with the startup. They say that, okay, 2% or 3% of revenue share, we will take it only when you make revenue for a certain period, say 3 years or 4 years. It cannot be perpetual. Equity is actually perpetual as long as you hold stock in the company because it's ownership. Revenue is on annual basis, it is getting reflected, and incubator can negotiate with startup, have a contract or agreement to share revenue for a certain limited period. Yeah. So it does allow to partake in success of the company. However, it is in a limited manner. Like valuation jumps exponentially, revenue doesn't go so exponential. The main factor about revenue share is that like it reduces basically cash for the startup. Startup do need cash for themselves in initial years. So when they share the cash with incubator, it is disadvantageous to the startup. And therefore, like, you may allow them to retain revenue up to certain amount and start sharing revenue share only after certain, like, they achieve certain number. And I have some example I'll share in next slide out there. Here also, like, revenue percentage, it is very important so that you not too much cash you are taking away from the company. How many years you will share the revenue? Typically in India, in our incubator, we had written this formula that whatever years of support or duration of incubation support we could give to the company, we will take that much years of revenue share. So if they are in our incubator support for 3 years, we will share for 3 years. 4 years, they remain in incubator, then we will take share for 4 years. And if it is for 1 year, then we will limit to 1 year. Yeah. And typically there is a cap and floor so that incubators also know the risk of the cash or how much cash will outflow from their company over a period of time. The advantage of this model is that it allows participation in the success. Also, it doesn't create liability upfront, and it allows startup to retain its equity, and it's quite predictable. The disadvantage is that it limits the like, share in the success, as well as there is a risk of failure. So that is also the case. And then it takes away cash from the startup in early days. So that is the disadvantage for this. This is the table, it may give you some sense. If the revenue percentage, so if incubator and incubator decides an agreement that incubator will take away 3% in revenue share for a period of 3 years, and they use floor of $50,000, so up to $50,000 of revenue, no revenue share, no sharing will be done by startup in favor of incubator. And there is a maximum cap that up to 200,000 of revenue they will share. Anything beyond that, they won't share this. And you can see how does it go. If year one startup doesn't do $50,000, you don't share anything. Startup do 100,000, yes, you share up to $3,000. So if you can see in the second column, if there is any change or deviation, even revenue gets adjusted out there. And once 3 years is over, there is no revenue share. Yeah, that's how this model works. One more model is basically success fee. Excuse me. Yeah, success fee. Now, this is a tip.
Yeah, there seemed to be some interruption in her connection. Should I check with her? Yeah, I think she's back. She's back.
Yeah, I think I'm back. I'm sorry, I had some issue. Can you hear me?
Yes, fine.
Yeah, sorry. Okay. So I don't know where did do you want me to start this again? Or you could?
Yeah, you were discussing on the revenue share from the startups.
Oh, so did I complete this table?
Yeah. So this was a slide. 12 you completed.
I think we lost here again. I have the PowerPoint, Dr. Bala, if you want.
Okay.
Let me just bring it up. If anybody has any points that they like so far, if any questions, you can also leave comments on the chat.
Hello.
Yeah. Pani, Raud is sharing the slides because your connections were getting interrupted. So you may continue from slide 12. 12 you completed, probably from 13 you may.
Yeah. So next slide, please, Raul. Yeah. No, successful. Previous one. Yeah. Please stop there.
Okay.
Yes, please stop there. Yeah. So success fee, as I this is a typical model only for those startups who are not under formal incubation support, because if they are under formal incubation support, it is a responsibility of incubator to provide every support that startup needs to achieve a success. But when startup is not under formal incubation support, but they come for only specific value addition, that's where this model is more relevant. Yeah. It could be, there could be some flat fee for achieving certain milestone. In fact, incubators create a cohort around such milestones. So giving certain customer traction or access to international market or product development support or regulatory clearance, strategic partnership, getting some funding or exit event like acquisition or next round of funding. So this kind of cohort can be created for a group of startups in a very specific time frame, 3 to 6 months, and wherever there is a successful transaction, incubator can charge this successfully. The advantage is that it's for an incubator, there is an additional revenue stream. Whereas, and also since success is, since it is linked to the success, no extra burden for the startup. Disadvantage is that this cannot be a consistent or predictable flow of income here. And success translation may not be very high. Rod, next slide. Rod, next slide, please. Yeah. Now, this is a second target client group. Typically, when when you talk about startup and especially high growth B2B startup and in a mature ecosystem, there is a symbiotic relationship or roles that industry, startup, and incubators play. They all leverage each other for their individual advantages. Industries have open innovation program. They provide market validation, market access, they have CSR funds. Yeah. So incubators have here opportunity to create and execute partnership program for a fee. So there could be a program fee for accelerator or CSR. They can organize problem statement specific demo days for corporates. And they may also organize several events on behalf of industry partner. And again, success fee from startup can be additional revenue out there. In Indian ecosystem now, most incubators are regularly engaging with industry partner, and they are also basically leveraging some revenue stream from this client segment. The advantage is that getting into industry network and having a strong corporate relationship also adds to other cohort members in the incubators. This brings also additional source of income, and like incubators visibility also becomes very, very large in the network. And most incubators then basically help startup work on real industry problems. The disadvantage is that there's a limitation how many cohort program you can run parallelly. You cannot have too many cohort program. Also, at times when you do partnership program, there is a danger of losing the focus. Next, please. Government and multilateral agencies or institutions, they play a very important role, especially in early days. They have grant programs, capacity building programs, special that takes care of initial cost of running incubator. And this is the time cushion that incubator actually used to build a long time sustainability path. Program fee or the reimbursement of the cost can also add to the revenue of incubators. There's an advantage, like as I said, that there's a very predictable source of income, cost reimbursement for several years, as well as since you work with multilateral agency as well as government, you could also influence the policies. The disadvantage is that most of this program, there's no flexibility. So we have to be driven by only what this the upfront funder basically wants. And many times there could be also mismatch of objective, and that's where the core objective of incubator has to be basically kept in mind. Next slide, please. ESOs. Now, ESOs also is a very important client segment, like foundation, NGOs, incubator, mature incubator can support younger incubator or other accelerators, innovation lab, universities. In fact, some of our incubators in tier 2 town, they help basically incubators and university in tier 3 town by charging membership fee. So that becomes a very good basically revenue source for them. And the customized service could be consulting, training, workshop, and so on and so forth. Same thing, advantage is visibility of incubator goes high in larger network, and there is a potential for cross leveraging of network also. Disadvantage is again losing there is a risk of losing focus. It's not necessarily a good idea to have this as a long-term business model. Next slide, please. Yeah. So based on our experience, the typical maturity metrics is like early stage incubators less than 7 to 8 years, mature is more than 7 to 8 years. If you look at it, approach for early stage is basically build pipeline, create capacity building, infrastructure building, cohort of high growth startup with long gestation period. But the revenue stream is initially grant, incubation fee, pay per use, typical related to infrastructure. But revenue for a long term, especially for mature incubator, they develop healthy mix of revenue from multiple sources with significant revenue coming from the startup. And especially equity basically becomes a very important and larger contributor in revenue stream. Yeah. And mature incubators are also expected to create new initiative like commercial funds, long-term partnership initiatives, and so on and so forth. And out there also they have some kind of the visibility of revenue coming from new initiative. Next slide, please. So this is what we suggest to our incubator ecosystem. Like typically, if you are focusing on core objective of incubator, or if you are to be seen as an incubator, 50 to 70% of your revenue must come from your core target group, which is startup, and then 10 to 25% from another group. This is depending on each ecosystem, or which each country's their own specific environment. It can differ, but it is important that half of the revenue should come from incubator to be able to call as a successful incubator. Next slide, please. Especially in I think I have a mistake here. My apologies. Revenue mix for emerging ecosystem. Typically, it's grant and multilateral agencies, partner programs from corporate and international agencies, and then there are also incubators small incubation fee, revenue shares, success fee. Those kind of model can be experimented. Also in emerging ecosystem, that's where the India has also gone through. The advantage for emerging ecosystem is that the incubator play a very important role, or they have an important voice in shaping this entire startup ecosystem. There are lots of knowledge gap that incubator can basically, fill in. And that's where they can also create some kind of revenue stream by way of consulting or policy shaping in this particular, ecosystem. Next, please. I think I'm almost pretty much at my end of the slide. So, the conclusion of the paper is that, depending on early stage and mature stage, the focus is very different. Early stage focus is infrastructure, pipeline building, capacity creation, and revenue stream is limited, aligned to this activity. As incubator basically becomes mature, go to the next level, the value offering also changes. They need to, they also engage very deeply with the company in a long-term basis to basically, leverage their long-term success, and revenue stream is also more mature in that sense. Typically, incubator have to have a mixed revenue. Single revenue stream is not going to work out. At the same time, balance has to be struck between serving the needs of the different stakeholder as well as maintaining core objective on incubating startups. Incubators need to invest heavily in developing and improving sound processes and practices which allow them to select high quality companies, which will give them larger return in future. Similarly, startup success will only translate into like economic health of the incubator. So this is pretty much I'm end of my presentation. I'm happy to answer any question. I think we are done with that, Rob.
Thank you so much, Poini,
Yeah. So,
for your share.
yeah, so Rod, this was the paper highlights for us, but main thing is that this is not a theoretical aspect. It is really practice in India. In fact, Indian ecosystem, many of you may be aware, it is almost 2 decades old ecosystem. And like, 20 years back, we were emerging. We didn't have startup milieu. We didn't have angel investors or VC. Industry was not engaging with academia, forget with startups. So we also have come a long way in that sense. And each of us have evolved depending on our the strength. We have evolved our own incubation model. So I would request basically Bala to share few models, different models that we have tried in early days and how they are practiced even now or they have evolved now. So over to you, Bala.
Yeah. Thank you, Poini. That was an excellent presentation. I would even term it as a masterclass on self-sustainability, covering a wide arena, and so very insightful one. So I'll start with our own experience of 20 years, how an early stage incubator in fact, fortunately, we had this focus of sustainability thanks to the government's prod that within 3-4 years, the incubator needs to be sustaining itself. So initially, we had a set of equipment provided by the government grant. In fact, they were state-of-the-art 3D printers at that time. So industry was lacking this system, and we were in a position to capitalize on the availability of these 3D printers, and we were one of the top 10 service providers those point of time. So I'm talking about 2003 and 2007. So because the initial stage as an incubator, building a credibility for the incubator is difficult unless we see a set of companies coming out, and it takes 3, 5, 6 years. So we heavily counted on the availability of the equipment and some training programs. So these were the kind of low-hanging fruits to build on sustainability. Eventually, 2007 onwards, having gained some experience in innovation and entrepreneurship, we also bid for a World Bank's project. It was an international capacity building on incubation, sharing the experiences gained in the Indian ecosystem with other global South-South partners. So that was another help for us to build our incubation capacity, alongside also sustain our activity for a couple of years. So this also helped us to get some more grants from various government agencies, on all related to innovation and entrepreneurship, whether it was Technopreneur Promotion Program or Technology Refinement and Market Assessment Program of TIFAC. And there were other biotechnology grants, and the Ministry of Micro Small Industries. Then there were programs by Ministry of Electronics and Information Technology. So over a period of time, there were multiple partners coming on board, because success breeds more success. You also gain some significance in the process. But today, when I look at it, so we were one of the first 5 incubators in the country to implement seed funding. But unlike Sign, we did not have, being from a second-tier town, we did not have the bandwidth to go for the equity investments. We took a while. We took almost 10, 12 years even to think about equity. Initially, the funding was predominantly on debt, and now we started doing equity. We hold about equity in about 20 companies. One profitable exit we had a couple of months ago, and this gives us enormous confidence to move ahead in this. So the point here is we also need to figure out what works locally within our environment. So the other aspect is we are part of a large private university. A lot of intangible support is coming, which helps us to save some costs. And in turn, we also provide value to the institute by participating in several innovation and entrepreneurship capacity building, offering high quality research services to the research scholars. So it's a kind of a win-win and a give and take process. So I also want to highlight some of our experiences in the ecosystem, what did not work for some of the incubators. When you also pointed out not losing focus, but some of them have lost focus on the grounds. I know one incubator started running MBA program way back in 2005-06, and both MBA and incubator are shut now. So they could not succeed in that. And so there are organizations who have become training providers, and they are completely branded as training centers, not as incubators. There are organizations who have gone on bidding for international projects. They are so good at it, they could not come back to incubation. They're moving on with other international projects. And so there are incubators who were so good at funding, they eventually become more of a venture capital funds than incubation. That incubation focus has gone. So there are a lot of lessons to be learned alongside. And then we also need to factor in your organization's core objective. I know from the initial response in the slides, I see at least a majority of the incubators participating here are mentioning that they are somewhere between 2 to 3 on a scale of 6 on self-sustainability. So this is definitely the case with the most of the global south. India was also there, even.
Have we lost Bala? Yeah. I need to just give me Rod. Give me 2 minutes. Let me check whether he is there or not. Let me check.
Yeah. Again, if you have any questions, Dr. Bala, are you there?
Yeah.
Yeah.
Okay.
Bala, we lost you in between actually.
Okay. So, I mean, where I was talking about the global south and the difficulties which are similar to other geographies, and I was trying to highlight on that. But Poini, in case if you want to bridge the conversation and take further time in terms of Q&A and interaction, I'll be more than happy to share some more points.
Thank you. Thank you so much, Poini and Dr. Bala, for sharing your experience in the Indian ecosystem and also giving some of the advantages and disadvantages for each of the different streams and models that incubators can use. I'd like to open the floor up to anybody who wants to share either any experiences that they've had in their own regions and ecosystems, or if you have any questions that you'd like to ask Poini and Dr. Bala about their experience, you can raise your hand or just unmute yourself. Yes, Amos?
Yeah. Good morning, good afternoon, good day to all. Have been a very wonderful listening to you all, your presentations. I'm Dr. Amos Obi from Nigeria. I'm the principal innovator, the head of our skill academy for innovation and entrepreneurship, training people on digital entrepreneurship and green enterprise to solve the problem of poverty, hunger, social injustice, and climate change. Now, from your sharing, I want to ask, what is the provision or policy direction for the India government to help people from other countries who might be interested in coming to set up startups in India? because from what you have said, you have a robust way of encouraging startup, which some of our regions here in Africa, especially Nigeria, is not really common. So a lot of people will be interested and see such provision. So is there any arrangement or provision for that for startups that are coming from other countries who take advantage of your startup environment in India? Thank you.
Yeah, Poini, may I take this question? Yeah. So in fact,
you can take it. Yes, Bala, you can take that.
Yeah, in fact, we have done that in multiple ways. As I mentioned, in terms of knowledge and information sharing, both under the InfoDev World Bank program and also in the UNIDO program, we have done that. With another senior colleague of mine in the ecosystem, we went to Philippines at the invitation of Philippines government for about 10 days. We had a complete immersion on incubation planning to operation to managing to fundraising. All these were given as a 10-day module for about 60 professionals in the Philippines. So based on our inputs, even in 2014, Cote d'Ivoire and Guinea have set up some incubator programs through UNIDO's intervention and local government intervention. So we'll be more than willing to assist. As I mentioned, we are from Indian Steps and Business Incubators. It's an association of incubators with 150 members. Poini is an advisor to the organization as of today. And we have many senior professionals. So we could look at country-specific partnerships, both at the organization level and as a country, as a association level as well. So we'll be more than happy to discuss further. Poini, would you like to add something?
No, I think you put it very rightly, Bala. So I really don't need to add here.
Yeah.
I think there
Thank
is
you,
another.
Dr. Obi. Sorry, I just wanted to plug also. So, Dr. Amos, we do have a Pollinate Potluck coming up in December where we gather our network members as well as ESOs who want to join the network. And this year we are doing it in Bangalore on December 4 to 6. So that would be an opportune time also if you want to kind of explore how the ecosystem is in Bangalore, then please feel free to join us in person for our potluck.
Great. I will be glad to have the invitation.
Awesome. Yeah, we'll send it to you.
Thank you.
Bala, what we could do is that with this basically, one thing is that Bala, our publication we can share with Pollinate Network, and whoever is interested, maybe they can like our association social media platform, so that they will get to know what is happening in India.
Yeah, I've also pasted a link about our oncoming annual conference, ISPA's annual conference, scheduled between 17th to 19th in Hyderabad in India. So one day is dedicated for incubator visits and master classes like this for the whole day on 17th of October. So if some of you may be interested, please follow the link. We are also expecting about 40 delegates from Asia Pacific countries. We are also partnering with the Asian Association of Business Incubators.
Thank you. I'll read out one question here on the comments. I think it's interesting the point you mentioned that it takes 7 to 8 years for incubators and accelerators to reach financial sustainability. In places like India and the Philippines, the government has been supporting incubators and university-based incubators, but with a much shorter timeline to become sustainable. I'd love to hear your perspective on this. Do you think the support is well placed, but not long enough?
Yeah, I think depending on every country's basically policy, support could be for 5 years, it could be 3 years. We also have some of the support only for 3 years. The key for basically incubator manager is that you treat the incubator like a startup. How startups are struggling to sustain, how they are finding their client segment constantly, how they are on the field and try to get basically customer to their, for their product and so on and so forth. So as an incubator manager, we have to have similar mindset. We have to constantly reach out to various stakeholders. We have to constantly work with those stakeholders on various partnership program. If startup may take little longer to basically give the return from a revenue share equity or whatever it is, but work on a model which could be success fee based model, right? So if you don't have a long term support, so at least go beyond your incubation center, look for the startup and see how much you can help, and then convert that transaction to the benefit of the incubator. So this is what I would like to mention. Bala, anything else for you?
Yeah, so when it comes to model, I would also align it with the geographies. So I know in 2006-07, Busy Internet in Ghana was providing incubation support by providing seamless internet connectivity and uninterrupted power and a secure workspace. So that was relevant and most needed. So one has to figure out what is locally relevant for the day and align your business model and revenue model along with that. Especially Global South, where deep tech is yet to penetrate, research-driven innovation is yet to take place. The focus could be on MSME enterprise incubation and organizing even some common facilities around the incubator where people come with raw materials, use the facility for value addition and also certification, and providing early risk-free funding assistance to entrepreneurs. So all this will form part of self-sustenance, I would suppose. Yeah.
Thank you. Dr. Amos, I'll come back to you. There's just one question here in the comment. Quick question for Poini was that I think it's 4% revenue share only to cover the costs of incubation support you provided, or did you also put in money into the businesses? And to what extent do you think revenue share alone can allow an incubator or an ESO to become financially sustainable?
Right. So this was actually for incubation support. We had taken equity by putting our money. So there was an incubation equity and then there was an investment equity. So we have experimented with everything. One is that as I mentioned, that one stream of revenue will not work. You need to have multiple mix of the revenue stream. So revenue stream basically, so revenue share is better than just having an incubation fee, because incubation fee is very small and you don't get enough money, but then because you are supporting startup in a very early stage, you are participating in their success. So it is justified that you also take a share from that basically risk that you have taken and investment in startup that you have done by in-kind investment, not necessarily in cash investment. So if you combine revenues share, revenue share, incubation fees, success fee, those kind of things along with partnership program, that will help you achieve. Standalone revenue share will not help you, but revenue share is better than just incubation fee, because incubation fee is very small. Here you incubation fee plus revenue, because it is dependent. If they get more revenue, you get more return. So that's how basically it has to be structured.
Thank you. Dr. Bala, do you have anything you want to add?
Yeah, so when it comes to this revenue mix, again, we need to figure out what is required in the short term, medium term, and long term. Equity returns are fairly long term. So in short term, the revenue from the companies or the fee which you charge or the training programs, this is also helpful. I would also reiterate on looking at in-kind support also from the local industry, if not totally cash support, wherever you are in a position to piggyback on some in-kind support where you reduce certain costs, that's also kind of sustainability. And I would also suggest plan for some corpus, as some of the times you will be wanting to incentivize your staff, give some extra allowances and all. But it's always better to save it for rainy days. Suddenly the grants might run out, and sometimes there could be some, like they say, funding winter. There could be a grant winter and recession, all that. Have a provision for some corpus so that your operational sustainability is not affected because of your revenue. And other final aspect to it, how do you sustain your team? that also matters because the team plays a role in sustaining your operations. So how do you motivate them, and how do you motivate their interest beyond the financial incentives, the organizational culture? So all this goes into the sustainability of an organization. Yeah.
Thank you. I think we'll do last two questions. So I'll go to Dr. Amos, and then there's one from Joram in the chat. So Dr. Amos, please go ahead.
Yes, I'm trying to say, in what way can we, because the present drive of the world right now is the Sustainable Development Goals of the United Nations. And we are talking about climate change eradication, poverty eradication, and social injustice, which is common to most regions of the world, really in developing countries. So in this case, how can we partner to scale up our unique model of the Health skill that specializes in capacity building on digital and green enterprises for sustainable development, helping people to acquire the skills and helping them to mentor them and helping them to set up digital entrepreneurship schemes, aquaculture, the area of green technology and others. So what way can we partner in this regard to scale it up, both in your region and other regions of the world? Thank you.
Bala, you can start and you can add. So I think SDG goals, sustainability, energy, environment, that's a big thing even in like, you know, across the globe. So wherever we go, like whether it's an emerging ecosystem or it's a mature ecosystem, everyone talks about it. As long as incubators are concerned, I think we see an opportunity here. You create a very focused, targeted cohort out there, cohort of the companies, startups, who have various offerings in under SDG broad umbrella. If an incubator can basically convince a partner to create a small fund, either for the product development or product deployment. So now there's a like you create a cohort of SDG startups under SDG umbrella. You provide like, you know, capital out there, and plus you have partners who help them in basically implementation or market access. So creating accelerator program makes lots of sense. I don't know whether I'm addressing your question or not.
You see, the problem of the world right now is common to most regions. Problem of poverty, hunger, climate change. Then accelerators could be a hub where people capacities could be built based on this problem of the world, how to solve them. Provide a solution that are entrepreneurial is solving this problem. In that case, we could do something to build people's capacity, especially youths and women, to see this problem of the world and see how they can create solutions. Then prepare them, help them to access funding. In fact, that would be a great service to the world. And the UN definitely will want to associate or definitely encourage such projects around the world. So that is where the Sustainable Development Goal comes in. Thank you.
Bala, you want to take that?
Yeah, two perspectives. So one, it's very, very essential, especially in the developing economies, to build the capacity of their youth. It solves two issues. If they become entrepreneurs, they become wealth creators. They also become job generators. So we did a youth entrepreneurship skills development initiative. There were about 20 entrepreneurs, and so after 2 years, when we looked at the stat, they eventually trained about 1,000 more people in West Africa, and few of them even started deploying some technical solutions in places like Liberia and Sierra Leone, even employing 20, 30 people in high quality jobs. So this is very, very essential. But to accelerate this, what we can also look at is the imitate, improvise, and innovate model. You start with imitation, you start improvising for the local adoption, and then it also builds capacity for local innovation. So some of the companies from other regions, the other global south, for example, India, Philippines, China, if they are good in some technologies, you could design some soft landing programs where some of these companies could come there and set up shops. And eventually, some of these technologies are licensed to the local entrepreneurs, and they scale up in the whole of African market or other East Asian markets. So these are all other approaches one think of.
Thank you. Thank you, Dr. Bala. Thank you, Poini. Thank you, Dr. Amos. I'd be happy to connect you through email after our session as well to discuss this further.
That would be great. That would be great.
Awesome. Yeah, no, happy to. I have one last question. Thank you for everyone who stayed so far. But I think Joram's question around what happens to the startups post incubation, like in your experience, is there an ongoing relationship with them?
Yeah. So as I said, like, we as an incubator, we used to take equity in the company, and equity is basically participation in ownership. So as long as we hold equity, we have relationship with those companies. Having said that, whenever startup needs post incubation, also whether we have equity or no equity, whenever startup needed any support, continuing support, or any later on new support, we would always, because they were under our program, we supported in them in past, and we continue to support in future also. And typically this support, we don't charge any extra incubation fee or nothing about it.
Thank you. Dr. Bala, any last thing to add?
Yeah. In addition to the points mentioned by Poini, we also invite them as mentors to guide some of the current set of the startups, and also engage with them for business opportunities. And so the relationship with many of the companies will be ongoing, irrespective of the formal association or not.
Yeah.
Great. Thank you. Thank you again, Poini and Dr. Bala, for sharing your expertise today. I think everyone is very engaged and learned a lot from the session. Thank you for all who have stayed to the end of our session. I will give maybe a minute or two for Sophia, our memberships mobilizer, to give a little bit about Pollinate Impact and how you can become a member of the network, while I also pull up our feedback form so you can answer while Sophia takes us through what it's like to be a member of the network. So if you want to take it away.
Thanks, Rod. Tess, would you be able to pull up the QR code? Thank you very much, Poini and Dr. Balachandran, for your insights today. It's been quite an eye-opener, especially for me. To everybody who has stayed until the end, our mission basically is to support the impact incubation industry by enabling you and resourcing you so that you can focus on what matters most, which is resourcing the entrepreneurs, working with the entrepreneurs who are there on the ground, facing the challenges, facing the communities across the challenges of the communities in the world. So if you are not a member of Pollinate Impact yet, we invite you to join us when you join the Pollinate Impact Network. We connect you to like-minded incubators who you can collaborate with each other, co-create solutions, as well as we organize sessions like this to capacitate your team on some of the issues that are most closest to you. So if this is something very exciting for you, you can scan the QR code in the screen. We can also send the application form in the chat. Here you go. And once we have received your application, I'll take you through the next steps in becoming a pollinator. And yeah, thank you so much for attending today. I will pass it over to Rod.
Thank you so much. So we hope to see organizations here become a member of Pollinate Impact. Again, just a quick plug. So we have our first potluck, which is our gathering of network members, happening from December 4 to 6 in Bangalore, India. Hopefully, we'll also be able to see Poini and Dr. Bala in person during the potluck if if they're available during that time. So if you want to join us in further carrying out how to kind of understand the challenges we're facing as an impact incubation industry throughout the global south, and also create or try to think about what solutions we'd want to move forward with in the next few years, then please join us for the Pollinate Impact potluck. So I think Ariel was able to send the link, but we will also be sending it through our thank you emails after this session. So again, thank you to Poini and Dr. Bala for joining us today and for sharing their experiences. And thank you everyone for being so engaged today. Hopefully we can carry out this conversation through emails, and then let's see if we can have another session around this, because it seems to be a very popular and very engaging topic for everyone. For now, thank you for joining us.
Thank you very
I
much.
hope you all
Thank
have a
you.
great day.
Thank you.
Thank
Thank you for having
you.
us.
Thank you.
Thank you. Thank you so much. Thank you.